Hello and welcome to our channel. In today's video we will talk about the collapse of Silicon Valley Bank, what it means to the US economy, which other banks are in the same boat, and what is the US government's reaction to stop the slide. So, let's get started. Silicon Valley Bank, SVB, the 16th largest US bank with $210 billion in assets, was seized by California regulators on Friday. Founded over a poker game in 1983, Silicon Valley Bank became the go-to lender for tech startups that appeared too risky in the eyes of larger, more traditional banks. Eventually, Silicon Valley Bank would come to do business with nearly half of all US tech startups backed by venture capitalists. If you're a high-growth startup, you can't get a credit card from a normal credit card provider. You can't get a loan from a big bank, but Silicon Valley Bank would give you that. SVB has done business with well-known tech companies including Shopify, Pinterest, Fitbit and thousands of lesser-known startups, in addition to established venture capital firms like Andreessen Horowitz. It focuses on providing services to startups and entrepreneurs, and many such companies also use it to hold funds that they receive from venture capitalists. So let's start with where the situation got difficult. In 2021, the market was soaring and startups were getting tons of money from the VCs. These startups were putting this money in SVB, which went from holding $61.76 billion at the end of 2019 to $189.20 billion at the end of 2021. Banks normally make money by loaning out a portion of the money they hold, but SVB was getting so much money that they couldn't loan out fast enough. So instead, they bought a bunch of long-term investments, in the form of government treasury bonds at a low interest rate. Government bonds are not bad, but they are exposed to interest rate risk. If the bank held these investments for the length of the maturity, they would be guaranteed a profit, but if they sold early they would have to sell at market value. This was a calculated bet, and would have been okay. Except that when the Fed started raising interest rates last year, the market value of these long-term assets started falling. Due to federal rate hikes and poor financial environments, it led to lower investment into startups, so more VCs pulled their deposits out. Startups also started to struggle and started withdrawing from their accounts more quickly. SVB was concerned they would be forced to sell their long-term assets early in order to support these withdrawals, which would mean taking a huge loss. SVB had very little liquidity, so it was forced to realize the losses on the older bonds. Higher uncertainty as more bad news of losses from SVB began piling up. It led to even more deposits being withdrawn, and more losses crystallizing, leading to a loop of destruction. In total, in last 48 hours, a total of $42 billion were withdrawn from the bank, and on Friday SVB announced a fire sale. They sold pretty much everything they could sell in order to raise cash, protect and balance out all those long-term assets, and improve financial health metrics. They sold over $21 billion worth of investments and are trying to raise $3 billion more. This has resulted into a bank run, where the customers have withdrawn the money so quickly that the FDIC had to shut down the bank and figure a way forward. The size of SVB makes it the second largest bank to ever fail, the first being Washington Mutual, which collapsed in 2008. In the meantime, Elon Musk tweeted late Friday that he was open to the idea of buying the failed Silicon Valley Bank, but Tesla investors appeared to disapprove of the billionaire's idea, telling him no thanks. Musk had sold about $23 billion of Tesla stock last year to help finance his Twitter takeover. Deposits insured by the FDIC will get their money back Monday morning, but as of their last filing, 93% of the bank's $161 billion deposits were uninsured. However, based on SVB's liquidation plan, it is likely that all deposits will be returned eventually, probably next week. Companies who banked with SVB are struggling to pay their employees today. Notably, Rippling, a company that manages payroll and HR services for other companies, has said that their payments flow through SVB, so any company that uses Rippling will probably have a delay in payment. Roku, the TV streaming provider, was among the companies caught in the middle, to the tune of $487 million, which amounts to about 26% of the company's cash. Are any other banks at risk? It's hard to say. The crux of the issue is that SVB sold their available-for-sale (AFS) portfolio to provide enough buffer to avoid selling their long-term investments. Their long-term portfolio, called hold to maturity (HTM), had big unrealized losses, and they really did not want to realize them. They aren't the only ones. In total, as of the end of 2022, banks were holding about $620 billion of unrealized losses in their AFS and HTM ports. Regulators did close Signature Bank, a $110 billion commercial bank with offices in California, Connecticut, Nevada, New York, and North Carolina, on Sunday as customers alarmed by SVB yanked their funds. On paper, Signature was on solid footing, and as recently as March 9 the company was touting its strong financial position. But its collapse underlined how quickly panic can grip banking customers, who often move their assets to large banks when uncertainty flares. Most larger banks have relatively smaller amounts of unrealized losses, but smaller regional banks may be at risk, which is why KRE, an ETF of regional banks, has dropped so much. Is the US banking system safe? President Biden on Monday morning sought to reassure Americans that the nation's banking system remains stable, saying that your deposits will be there when you need them. Bank industry analysts also expressed confidence that the banking system as a whole is safe. One reason that view might be right: the failures of Silicon Valley Bank, Signature and Silver Lake appear chiefly a result of financial issues specific to each bank, exposure to interest rates at SVB and exposure to crypto industry losses at Signature and Silver Lake, not systemic issues with America's banks. In other words, these banks collapsed for markedly different reasons than those that slammed Lehman Brothers in 2008, as well as the broader lending industry during the ensuing crisis, issuing risky loans to millions of households and businesses across the country. Also, because of its relatively modest size, by comparison, JP Morgan Chase, the nation's largest bank, has more than $3 trillion in assets. SVB was not subject to the Fed's regular stress tests. Bigger banks in the US, along with smaller institutions in Europe and the UK, are subject to such reviews of their financial health, reducing the odds of a larger meltdown. Is the crisis over? Not yet, although most banking experts and market analysts think the immediate financial crisis will pass. For now, markets are not anticipating a Lehman Brothers-style panic, and based on existing information that is a reasonable response, but if we were in a Lehman-style environment, the Fed would have already cut rates. The political reverberations, however, are likely to persist for some time to come. Expect lawmakers to summon banking regulators and industry executives to Congress to explain what happened and how to shore up lenders to guard against future bank runs. Yellen is likely to face questions about the situation when she appears before the Senate Finance Committee on Thursday to discuss the Biden administration's 2024 budget. One key question will likely center on whether bank customers across the U.S. with funds exceeding the FDIC's $250,000 insurance limit can always expect the government to step in when lenders collapse. Although such government backstops can help ensure confidence in the financial system, critics say it also creates moral hazard, leading bank executives to take the kind of risks that required taxpayers to ride to the rescue in 2009. Longer term, financial regulators are likely to face pressure to tighten their oversight of regional banks, especially of lenders like SVB with a large share of uninsured deposits. According to analysts at JP Morgan, uninsured deposits roughly total to about $7 trillion in U.S. banks, which average around 43% in the bigger banks, but that figure can top 60% for some regional institutions, a risk when lenders topple. Overall, the lesson is very clear here. SVB collapse by itself will not cause the U.S. financial system to break, especially since the government has provided such a calculated and swift response, but at the same time, with the current economic environment and increasing rates, we are not out of the woods. Please share your thoughts in the comments. And I'll see you in the next video. Thank you very much.